Morning, everyone. Thanks so much for joining me this morning for our webinar on cash flow made easy. My name is Kristy Bailey. I am a presenter and an advisor for Business Station as part of the Digital Solutions Commonwealth funded program. So my experience comes from owning my own business and operating my own businesses. So just a quick disclaimer, I'm not an accountant or a bookkeeper. So really what I'm going to be talking about today is cash flow and how you can improve your cash flow position, but really from that, that operational side of things, and that's a very like I said, very operational side. So the webinar today is designed to be interactive. Please stop me at any time. You can use the Q&A functionality to ask questions or the chat, whatever suits you. Just keep in mind, I'll also stay online for a few minutes after the webinar to allow time for questions. So fire away at any stage. Now, in terms of what we're going to go through today, throughout the webinar, you'll gain an insight into the cash flow process and how you can therefore manage it. We'll discuss what cash flow actually is. You'll discover the difference or perhaps even the relationship between profit and loss and cash flow, and learn to create your own cash flow forecast if you don't already have one. We'll also look at how you can develop an analytical approach to managing your cash by effectively tracking your performance against your projections as well. And then finally, we're going to look at some strategies to stretch your cash flow even further. All right, so getting straight into it. What is cash flow? Well, cash flow is a term that's used to describe the amount of cash or actual dollars that's generated or consumed by a business in any given time period. Now, cash flow itself has many uses, both in operating your business, but also in performing a financial analysis of your business at any given time. I believe it's one of the most important metrics in all finance and accounting because it really is the lifeblood of your company. It allows you to evaluate the flow of funds within your business and then identify where and when there are potential problems. And I think that when side of it is really important as well. If you're looking at the end of the year, you can go, yeah, we made it through the year and everything looked great, but there could be certain periods within that year that you are actually having difficulties. So understanding your cash flow is an absolute key component of your business success. So if you can find out how to manage it, then you will be able to identify ways that you can stretch it even further. If you're in a positive cash flow scenario with your business, that essentially means that you'll end up with more profit. All right, so talking about profit, what is the difference or perhaps the relationship between cash flow and profitability? Well, profitability is the ultimate goal when it comes to the financial side of running a business, but you don't normally determine true profitability until the end of a period of time. And normally that's a quarter or a financial year even. So the key difference between cash flow and profit is that profit looks backwards or it's retrospective, as opposed to cash flow, which is forward looking, and it's more of a forecast essentially. Profit is the amount of money that's left over after all of your expenses have been paid. And like I said, typically that we look at that at the end of a financial year. And making a profit really basically means that you've made enough sales of your product or service to cover all of your existing costs or all of those expenses, and you've got a bit left over. Cash flow indicates that net flow of cash into and out of your business at any particular time. So that could be outlined in weeks, it could be months, or it could be years, depending on how you set up your reporting. And that is entirely up to you. And we'll look at that when we get to the forecast side of things. Now, cash flow does matter, and it matters a lot. Having good or positive cash flow means that you'll have enough money to pay all of your expected expenses when they're due. You'll know when you're able to reinvest in your business and potentially purchase capital or any other assets that you might need to grow your business or even to run it more effectively or efficiently. And you'll see when it's appropriate to even return money to shareholders or take money out yourself. You'll also be assured that you've got a bit of a buffer to cover you against any future financial challenges that might arise. Now, that could be anything from unexpected equipment replacement, there could be legal expenses or anything unforeseen that might pop up within your business. Things do pop up, so you really have to know that you can cover them. Now, having cash flow problems means that you don't have enough money in the bank for these necessary expenses, let alone anything unexpected that could that could arise at any time. So you have to keep in mind that you can have profitability yet suffer from cash flow problems as well. So like I said, at the end of the year, you might have a look and go, yeah, we're profitable, all good, but there could be certain periods of time and there's overlaps. You might have clients that pay late, or you might have early paying terms to your suppliers, and a combination of the two makes a massive impact on your cash flow. And they're the most common reasons that people have cash flow problems. Now, if you can figure out your cash cycle and payment terms, is obviously one of the first things you have to look at or consider, you'll be able to keep your cash flow positive. So in an existing business, if you're already established, it is really important to continually analyze this. But if you're looking at it from a startup point of view, your first goal has to be maintaining a positive cash flow, obviously. And then once that's under control, you can then pursue that ultimate goal of making it as profitable as possible. All right, now looking at tracking cash flow. So you may or may not be tracking your cash flow already. Tracking cash flow is an absolutely crucial component of operating your business. It really allows you to operate profitably and generate positive cash flow. Otherwise, you need to make necessary changes to improve that cash flow. So, for example, you might identify that you need to reduce certain expenses or increase revenue in particular areas. It will allow you to look at what's working well and what's not working as well. You also are able to set budgets based on what you know you need to achieve at certain times. So if you've had a look at you and tracked your cash flow, you might see that in July, that's a particularly low month and you're not going to cover costs in that month. So then you can start planning and looking at what you can do to either meet or exceed that budget. Now, as I mentioned, it also allows you to make sure that you have enough cash. Otherwise, you'll have to determine how you can get input. And that could be by way of you need to input funds personally. You need to speak to investors or try and get hold of someone that can invest in your business, or perhaps even selling assets. So all of that takes time. So you really do need to be aware of that well in advance so that you can look at how you can get that cash into your business. It also really allows you to make informed decisions on many areas of your business, but purchasing is a key one. You might be able to take advantage of purchase power by knowing when it's appropriate to do things like bulk purchasing, obviously your staffing levels, what level of sales you need to be achieving, whether you should lease things or rent space and that kind of thing. So with all of that knowledge, you'll be absolutely certain to reach your business goals and most likely find those efficiencies, which will allow you to not only reach your business goals, but hopefully exceed them. Okay, so we're having a look at creating a forecast. Because cash flow matters so much, it's obviously only natural that you should do everything in your power to increase it. So forecasting and knowing exactly when you'll have those inflows and outflows is the crucial part. Now, to do that, you need to map it all out. There are many templates available online, but I find the best ones are those that are on the Australian government websites, business.gov.au. Banks and a range of other websites normally have downloadable templates that are available in an Excel format. Generally, they're free, so I wouldn't expect that you would pay anything for one of these templates. And I will show you an example in just a moment. But once you've got your template, to get started, you've got to decide, first of all, the period that the forecast should cover. You'll add in all the cash inflows that you are projecting, and then you'll deduct all cash outflows for each period. So generally speaking, a month-by-month cash flow is the most common. Depending on your business, you might consider doing that week by week. But obviously, that's breaking down the data a significant amount more than it would be monthly. Now, for existing businesses, a really good way to get started with a cash flow forecast is to get all of your data from previous years and input it into your forecast. So all of your expenses is a really good place to start. Have a look at each expense as you're inputting it into your template, and have a look at that point, are you going to make any adjustments? Also, with your inflows, you can input what you've done in previous years and again decide if you need to make adjustments based on past trends. So you could have determined that sales will be increasing or sales could be decreasing or even staying the same, but you can make those, do that analysis and make those I guess, make those predictions essentially, or projections on your inflows. If you're a new business and don't have any of that historical information, when you prepare your cash flow forecast, I would start by estimating all the cash outflows. So everything that you know that your business is going to have to pay for. Once you've done that, you'll get an idea of how much cash absolutely has to come in to cover the cash that's outgoing. And therefore that gives you a target of what sales you need to make to cover that. You might then do an analysis of that and project that sales will be slightly higher, and that will end up being obviously profit. But you do have to keep in mind that sales figures always change, and that's because they depend on so many different factors. So it could be the types of customers that you sell to, how quickly they have to pay you, what the economy is doing, is there interest rate increases, or are there higher or lower unemployment rates? What is the what's the market doing, and obviously what your competitors are doing. So when you are forecasting from a sales perspective, make sure that you are extremely realistic. We're going to go back and compare your forecast against your actuals month by month, so you will be able to make those relevant adjustments. But it's absolutely crucial that you are realistic when you're forecasting. Otherwise, you might find yourself in a situation where you simply can't cover costs because you haven't met the sales that you projected. All right, so I'm going to show you the template now, which is on your screen. So this template is one that's available from the business.gov.au website. As I said, the Australian government site. There are a range of different templates available. I think this one's really simple and easy to use. Now, the thing to keep in mind, cash flows are all about timing and that flow of cash. So you have to obviously start with an opening bank balance. Now, that will just be up here. You'll put an opening balance in there. And that's really the actual cash that you have on hand. So obviously input that first. Then you add in your cash inflows and cash outflows. So cash inflows are up here, and that could be sales of your product or service, asset sales, obviously any debtor receipts, any loans that you will be taking out that will give you input of funds, or any other income that you might be receiving. Keep in mind, it could be government grants and funding, it could be GST rebates or tax refunds, it could be your own investment of cash to add extra equity into the business. There could be royalties, franchise fees that you're receiving, or anything else. Any incoming funds will go into this section, this top part. And then you'll get a total of all the incoming here month by month. And this one is obviously financial year, so it starts in July. Now, the next part here is your cash outgoing, so your outflows. Having a look at that, will you be purchasing any stock? Consider your accountant, solicitor fees, any advertising and marketing that you're going to be doing, what your monthly bank fees and charges are, any interest that you're going to be paying on a potential loan that you've got up here. Credit card fees, there's utilities, there's telephone, there's lease and loan payments, rent and rates, there's vehicle expenses. So absolutely anything and everything that is an expense within your business will go here. Now, this will do a basic sum. So you'll have your total incoming and your total outgoing, and that'll give you a monthly cash balance. Now, the bottom line here is going to be your closing balance, which will be your opening, sorry, it's just disappeared, your opening balance plus your incoming less your outgoing will give you a closing balance. Now, that'll roll over. So whatever it says down here at the bottom of July, down in there, that will then roll over and come up to the top to start your August month. So you'll always have your monthly cash balance, which is incoming less outgoing for that month. So you can see if a month, if you're starting to see reds along here, you might identify that you need to do work in that month, but you could have had a really good August, for example. That means that your lower September is covered. So you'll have to you'll do an analysis of what that looks like based on a template like this. This is really straightforward, and it just lays it all out in one space for you. Obviously, a couple of things that you need to consider with your outflows. Don't forget, obviously you've got all of your running expenses and really good examples that are listed there, but in these templates you can adjust any of those cells to put your specifics in there. But just don't forget any payments to yourself. So if you're planning on taking any money out, make sure it is planned, and we'll talk about that a little bit later, but do keep in mind that as a business owner, yes, you're absolutely entitled to take out some money as and when you can, but if you plan for it, it'll mean that you're not impacting your cash flow negatively at times that you might need it. Also, don't forget to account for GST. If you're including it in the sales in that top level, then obviously you need to account for it coming back out in the expenses, as it will be obviously cash outgoing. PAYG and super and those kind of expenses are also well known. You know them in advance, so don't make the mistake of not accounting for them. So that's pretty straightforward, and I'd encourage you, if you've done nothing else from a cash flow perspective, absolutely grab hold of one of these templates and just plug in even last year's information. I think it's absolutely fascinating to see what things look like month by month. All right, so now we're going to talk about some strategies for improving your cash flow, which is really kind of the good part of today's session. Once you've mapped out your cash flow and you're all set up to track it, you'll identify if you need to improve it. So no matter whether there's a profit or a loss showing on your cash flow statement, you should always look for ways to improve it, because that'll equate to more profit for you if you are already profitable. So strategies for improving cash flow fall into one of three categories. You've got revenue growth, you've got operating margins, and you've got capital efficiency. So of this table that you see on your screen now, we're going to look at some of the key areas within those three main pillars. But for your business in particular, it's absolutely worth looking at all areas of your cash flow, depending on what's relevant to you. So keep in mind, a lot of what we're going to be talking about here is actually marketing. It's strategic marketing. But first, you need to understand your position to be able to improve your marketing and subsequently improve your cash flow. So the three main pillars I mentioned: revenue growth, and that's essentially the volume of goods and services that you're selling or the price of what you're selling it for, and looking at strategies within that. Then you've got operating margins, which is your cost of goods sold, as well as your selling, general and administrative expenses. And then you've got capital efficiency. So that's really just a question of how efficiently you're using your cash to operate and grow. So looking at property, plant and equipment and inventory. So we're not going to go through absolutely every aspect of what's on this flow chart on your screen, but we are going to go through the key areas, starting with pricing. So many businesses that I deal with, or when I first start working with them, really don't know if their pricing is actually right and if their prices cover costs. A good question that I always have to businesses as well is what specific products or services are profitable, or which of your products and services do better than others. And most business owners tend to have a pretty, high level understanding, oh yeah, that sells really well, that sells really well. But do you actually know what are your most or even your least profitable products and services? And thinking about that, how can you increase those products and then decrease the less profitable products? And then also considering how much time is invested in each of them. So when you've set your prices, again, and then another question that I will always speak to businesses about is, how did you set your prices? Have you based it on what it costs you and then just a straight percentage markup? Or have you looked at what your competitors are charging and then making sure that you're just slightly above them or slightly below them, depending on, what your strategy is there? Or is it just based on, that the customer won't pay more than X amount for your product or service, so you keep it at that? So I believe that you have to look at all three of those elements to be effective. You can't just base your pricing on what it costs you plus a markup, because you might not be competitive. And similarly, you can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs nor making a profit. So you do have to know what your competitors are doing, but you also have to know your own worth. So identifying your weaknesses or any gaps in what you're offering when you're doing some research on what your competitors are doing, that will really make sure that you offer a fantastic product or service that is superior to your competitors. So again, like I said earlier, this goes back to marketing strategy. What is it about your product or service that's unique or different, or what sets you aside from your competitors? Can you charge more because of that, regardless of what your competitors are doing? Or do you want to base your pricing on more volume, less profit? So keep that in mind as well. Now, when it comes to pricing, discounting generally means more work to make or maintain a margin, whereas increasing your price means less work and potentially fewer customers to maintain your margin. Now, by increasing your price, you might be cutting out a certain market. And on the flip side, by decreasing the price, you might be attracting the wrong market. So there's some good examples of that when you look at some of the bulk buying websites. You've got your Groupon, Scoopon, and those kind of examples. And sometimes you might sell tons of your product or service on those, but then the customers that are coming to you, are they as easily satisfied? Do they spend as much when you're trying to on-sell and upsell and cross-sell them? Are they as loyal? Do they turn out to be repeat customers? So there's all these questions that you need to consider when you do look at any kind of discounting or any kind of promotion as well. So with your pricing, really delve into that in depth as opposed to just setting a price and going for it. Now, when you do your cash flow forecast and you have the sales inputs at the top level of that, you can tweak those. So look at if I was to increase my product by say $5, how does that affect my overall cash flow? And if you've got some good calculations in there, then you make that tweak and just see how it changes, and likewise decrease it a little bit and see how that impacts your overall cash flow. So really interesting things to do once you've got everything mapped out into that forecast. All right, then looking at volume. Can you increase overall volume, and specifically the volume of more profitable products and services, which is, the key question? Or are there new markets to sell to? Could you even create new products or better sales processes to allow you to produce more? So what you see on the screen here is a profit enhancement table, essentially. So there's a few different options that's outlined in this table. So the first one in blue is market penetration. So selling your existing product to an existing market. So that occurs when a company penetrates a market in which current or similar products already exist. So you're basically taking your competitors, taking customers off your competitors. The next section, the green, is product development. So this is developing new products for existing markets. Thinking about your business, can you launch a new product or service? Or maybe through what you've identified in researching your competitors, there's something that's cropped up, or you've tracked trends on consumers and you know that there is an opportunity to develop something new for your current clients, your current market. The orange section is market development. So that's where you've got existing products that you're trying to pitch to a new market, or you're developing new markets. So this is broadening your scope to a different market. So for example, this could be going into the international market when you currently have the majority of local customers. It could be if you've got a storefront, you might then go online, or you might be an online shop and you might do something like have a pop-up store. So you're just trying to sell your existing products to a market that you haven't serviced before. And then that fourth element on this particular table is diversification. So this is where you've got new products that you're selling to a new market. So could you potentially spread into new areas, sell something completely different to your existing core product? So they're all business decisions that you have to make. But when you are making decisions, have a look at, okay, what is my profit enhancement strategy? Come back to this table and go, okay, well, this is what I'm going to do. In terms of volume, you also have to consider what your sales processes are like. If you had better sales processes, would it allow you to sell more? So thinking about how you sell, are there any bottlenecks in the process, or even how you manufacture? Are you at an absolute maximum of how much you can produce? Or if you're in a service industry, are you, limited by time and those kind of things? Thinking about increasing advertising, if providing the advertising is right, should increase the volume of sales. Now, obviously that has a spend attached to it, so you'd have to factor that in, going back to your cash flow template and having a look if that works for you as well. Also considering to increase your volume by having good salespeople. If they're good, make sure that you're retaining them. If you don't have good salespeople, have you got a plan in place to attract them to your business? The other volume increasing sort of strategy is to look at a customer rewards program. It costs something like 8 times more to attract a new customer than it does to get repeat business. So have a look at your business. What is repeat business like for you? Can you get people back? What can you do to get people back? Because it's going to cost you a lot less than getting new customers. And obviously that has many benefits associated with it, like word of mouth. If you've got loyal customers that keep coming back, they're more likely to be talking to their friends about your business or your service, but also generating online reviews and that kind of thing. So there can be many benefits to repeat customers, obviously. So that's volume. The next area to improve your cash flow sits with your debtors. Now, a really interesting ATO stat for debtors is that small businesses in Australia are owed $26 billion at any one time, and that's because of debtors. So you don't want to be a part of that. And the best way to address any issues with debtors are, first of all, to collect payments as quickly as possible. Maybe you want to look at offering a discount for prompt payment, or even on the flip side of that, introducing late payment fees. Now, late payment fees are very common with bigger organizations. You think of your power, water, your rates, sometimes, obviously, telephone companies. Everyone has fees for late payments. So, but thinking about your business, you'll know your own customer base and whether or not that would sit well with them. So think about what's most suitable to you. The next option is to invoice earlier. Some businesses will wait to the end of the month to send invoices. So you might have a product or service that's actually taken on the 1st of the month. You're not invoicing to the 30th of the month or the 31st, and then you've got payment terms that are, 2 weeks. So it's potentially 6 weeks in between delivering a product or service and actually getting paid for it. So perhaps look at sending invoices straight away. The minute that that product or service is taken, the invoice goes out. If you've got customers that will repeat purchase with you throughout the month, so you don't want to send them individual invoices every time a transaction occurs, you might want to do a mid-month invoice run and then an end of month, so they're getting 2 invoices. So think about something like that. Now, while we're talking about invoicing, looking at switching from paper to electronic invoicing. Electronic invoices are obviously a lot more professional than paper. They're easier to send, they're easier to store, you'll reduce turnaround times, but also making sure that payments are followed up promptly if they're not paid on time. Now, the more automated your system is, and electronic obviously, then you should have an automated payment follow-up system as well. So the more automated the process and the follow-up, the quicker you get paid and the less time that you'll need to actually put into getting payments in. Now, electronic invoicing is another option. You may or may not have heard about this. Electronic invoicing, or e-invoicing, it's a bit different to just sending a PDF by email. This is the automated digital exchange of invoice information directly between a buyer and a supplier's accounting system. So with e-invoicing, you won't need to generate a PDF or a paper invoice. Once you guys are connected, the supplier and the buyer are connected to the same invoicing network, using software like Xero, you'll be able to send and receive invoices. So make sure that you consider that. The majority of government departments are on e-invoicing now. So if you're working with government, it's obviously a great option for them. Now, another interesting ATO statistic is that it costs over $30 to process a paper or a PDF invoice. And that reduces to around $10 for e-invoicing. So that's just purely based on time and effort. So keep that in mind as well. Now, the other point I didn't touch on there was just reducing your terms. So have a look what your payment terms are on invoices. Is it 7 days? Is it 14? Is it 30? Reduce that right down, and make paying easy. Offer multiple payment methods to your customers so that when it comes time to pay, it's very simple for them. Credit card there and then on the spot might be easier, and it might really reduce the payment terms as opposed to invoicing. Yes, you'll lose a little bit in bank fees, but then you'll be having less cash flow issues and getting that money in a lot faster. So really do consider multiple payment methods and make paying very easy for your customers. Now, assets is the next element of what we're going to look at. With assets, this is really straightforward. You just need to simply look at if you can free up cash by selling underused or unused assets. Now, businesses tend to accumulate assets that at some point they won't require. So look at what assets you might have lying around. Can you sell unnecessary assets to increase your cash in the business and save on costs? Now, the cost that you will save on could be insurance. It could even be something as simple as storage and other operating costs. So look at that. Perhaps even leasing equipment to free up cash. So that will suit some businesses. Remember, leasing smooths out the cash flow. So you'll be charged every month as opposed to having a major asset. So it could, a major capital purchase, I should say, or an asset purchase. So it could work out better for you. It could mean that you remove the cost of maintenance and the risk of complete failure requiring replacement. So if it's appropriate for your business, it can be a really good way to free up cash as well. Refinancing or negotiating better terms with any existing loans or bank agreements that you might have is also a fantastic way to really consider, with a fantastic thing to consider with regards to your assets as well. That one's pretty straightforward. Now, expenses, put very, very simply, expenses decrease the amount of cash that's available to your business, obviously, as you will have seen with your cash flow forecast. So think about what you can do to reduce those expenses. Now, with regards to expenses, can you defer expenses or look at better payment terms with regards to any of the expenses that you've got on your cash flow forecast? Have a look at cheaper alternatives. Can you rent a cheaper location or negotiate a better deal with your current lease, for example? Are there any other cheaper alternatives to the expenses that you've listed? There could be new plans or technology packages. There might be some expenses on there that you think, do you know what, we're not actually using that. We don't need that anymore. So you can cancel subscriptions or remove certain expenses. Also have a look at reviewing things like insurances. Can you get quotes, get multiple quotes and compare them, and just make sure that your insurance broker or insurance company is being competitive. And lastly, have a look at the comparison in outsourcing versus in-house staffing. Now, we will talk about staffing a little bit more shortly, but just that can be really effective for specialist roles or particular tasks within your business. For example, things like bookkeeping, particularly with more automation, you might not need someone sitting there as a full-time employee. So that's something to consider. Marketing is another one where you can outsource specialist sort of marketing areas or any other administrative roles. So I'm not saying it's the right way to go, but it's something that you should consider or can consider within your business. Then we've got inventory. Now, inventory may or may not be appropriate depending on what your business is. So you may or may not have inventory, but inventory represents cash. So if you're holding it for more than 90 days, for example, it's going to cost you significantly. So in terms of your inventory, first of all, can you source cheaper stock or materials? So always review pricing from your suppliers and do it regularly. So you might have a supplier that you've worked with for years and years. You're very happy with the product that they deliver and the service. It absolutely can't hurt getting some comparative quotes. My recommendation there would be get a few comparisons. Let's say get 3 comparisons. And if there is someone that comes in cheaper than your current supplier, I would definitely go back to your current supplier and say, look, we're happy with the product and the service. We want to stay with you, but we know we can get this product cheaper through someone else. Is there any way you can do anything with the price? So I wouldn't hesitate to ask if they can match prices, for example. Purchasing power, I touched on this earlier, but once you know your own cash flow cycle, you could potentially have buying power. So you'll map out how much cash you have, obviously, in certain times of the year versus how much stock you use, and have a look if there's any efficiencies. You might know that a particular month is, by a particular month, you have a lot of cash in the bank. Would it be beneficial to your business to bulk purchase stock then at a much lower rate? So just consider that. There's no right or wrong with that. Obviously, like we're saying, inventory represents cash. So do you want to spend all that money on one particular month a year only to hold that stock for the rest of the year? Maybe, maybe not, but always look for efficiencies in terms of purchase power. With your stock, make sure that you are maintaining the right levels. So your stock shouldn't be too high, but you should never run out either, because that can really impact, obviously, your customer service. So track the movement of your stock, have processes in place to identify when new stock should be ordered. You can also reach out to your suppliers and try to return anything that may be unsold. But in order to do that, you really have to know your suppliers' return policies. So considering that, I know a lot of businesses tried to do that when COVID first hit, tried to return stock because they were closed down. So I think suppliers really tightened up on their policies and conditions at that point, but definitely know and understand your suppliers' return policies. Or otherwise, think about how to move your stock faster. You might have a store, so bricks and mortar, but you might then want to go online. And like we said earlier, you might be an online store and you might want to do some pop-ups to move stock. But if you can, use a software platform to manage your stock. You can do it manually as well by way of spreadsheets and that kind of thing. So just really understand what's selling well and what's not. And make sure that you're replacing slow moving or even obsolete stock with stock that has a faster turnover. Know what sells well and know what doesn't. And not just in your head and having an idea, yeah, that tends to sell very well, but actually see it on paper, exactly, what the turnaround times are on different stock items. Now, drop shipping, is something to consider, or just-in-time stock orders. You might be able to find suppliers who'll provide you with stock only when you need it. That way you're not going to waste money paying for stock that's sitting in a warehouse or a storeroom. So drop shipping in that sense can really work really well for some businesses. Basically, that's on the premise that you only order stock once you've had an order from your customer. But you have to consider a couple of things. Whoever the company is that is offering drop shipping or just-in-time stock orders, they have to get it right. I have heard some horror stories about the wrong products turning up to customers. Also, delay on deliveries. You have to avoid any of that side of things because it will impact your business name and your customer service. So if it's something that's appropriate for you, make sure that you truly understand the quality side of it and the timings of shipping. Now, the last item there is your supply terms or your payment terms. Make full use of your terms of trade because it equates to an interest-free loan for your business. So don't pay any invoices early. Perhaps negotiate your payment terms with suppliers to try and extend those out. We're going to try and decrease the terms with our debtors and increase the terms with our suppliers. So a combination of the two will mean that you're the one in the middle that holds the cash, as opposed to you're the bank sort of loaning it out, if that makes sense. So make sure that you are making full use of your supplier terms. All right, staffing is the next thing we're going to look at. Now, we did touch on this earlier as well. When it comes to staffing, this is an absolute key area that can become a major expense for businesses. So in terms of staff management, obviously, firstly, rostering to cover demand to produce revenue is obviously necessary. So you can't understaff, but also don't overstaff. So match the roster system to your peak periods. Have flexible staffing arrangements in place if you are able to, so that staff can essentially be knocked off at times when they're not needed, and then you can get them in at times when they are needed. Now, I did mention this earlier, but consider outsourcing, thinking about that. Are there any specialist roles in your business that you could outsource so that you're only paying on demand as such, rather than having a full-time employee in particular roles? Also, increase the flexibility of your workers so that they have multiple roles or that they're able to multitask, and train them accordingly so that they can multitask as and when they're needed. The last thing you want is a back office staff member, for example, sitting in a role and front of house, you're absolutely flat out, but they're not able to assist even though they're physically there. So that kind of, I guess training of your staff is absolutely crucial. Multitasking, it might not be their core role, but they'll need to know how to do certain functions. Aside from multitasking or having flexible workers, having a look at maximum utilization of your staff is an absolutely crucial element to your cash flow and your productivity. So thinking about setting targets so that you can maximize their productivity. And for each individual staff member. So could you incentivize sales, for example, with commissions, or reward staff behavior that improves cash flow? So you might have obviously sales targets, but you might have targets for reducing expenditure as well. So there might be bonuses for both. Now, obviously commissions and any kind of incentives are a great way to increase sales. But again, make sure that those commissions or those bonuses are only paid when you have got the payment, so that it doesn't affect your cash flow even more. So the last thing you want to do is be paying out commissions for a product or service that you're yet to receive payment for, because otherwise, again, you're the one that's losing out as the business. The qualifications of your staff is absolutely crucial, and my recommendation is to employ more qualified staff. So paying a staff member that's more qualified, so paying them more and they're more qualified, can really increase your sales, but also your customer service or your customer satisfaction. So that in turn creates positive word of mouth, which equates to repeat customers. So on a cash flow statement, unqualified staff that you're paying a lesser rate might look like a quick win, but in fact, they can be really damaging in the long run. So you see a lot of examples of this in hospitality. I tend to see this where, you know, you've got someone highly trained and a highly qualified wait person, for example, will upsell you to different wines that are paired with your food. They'll on-sell, they'll increase the amount that you spend because they know their menu, they know how to talk to people. You know, you might not think that you're going to go there and have 3 courses, but all of a sudden you found that you've had 3 courses and you've got, you know, nice wine and that kind of thing. And that all comes down to communication with customers, whereas someone that's less trained and less qualified just won't have the skills to be able to interact with customers in that same way. So keep that in mind as well. Don't be afraid to pay more for good quality staff, but retention is the key there. And reducing staff turnover is the ultimate goal, because staff turnover has a massive impact to your bottom line. Staff are very expensive to hire. Just the hire process alone is very time consuming and can cost a small business a lot of money. But then you've got training, and you know, and then obviously customer service. So once you've got someone that's quite new, is their customer service going to be the same as someone who's been there a long time? So you can absolutely avoid those unnecessary costs by being the employer of choice. Once you've got staff that are the perfect fit for your business, do what you can to keep them. Now, we've spoken about incentives. Just look at what you can do to actually ensure that those staff stay with you for a long time and be that employer of choice. All right, so that covers the different strategies to improve your cash flow. As you go through and complete your cash flow forecasts, definitely keep those strategies in mind. And then when you get to the point that you've determined if you have a profit or a loss, you'll need to make some considerations. So when it comes to profit, my first recommendation is don't be too quick to take it out. Invest it back in to manage cash flow for future months or future years, or use it to pay down debt. If your forecast shows a loss, then you'll have to, again, make some considerations. Will you input your own money, or will you seek that the directors input some funds? Will you look to get equity from investors? And if so, where are you going to find those investors, and how are you going to find them? And the third option is borrowing to fill gaps. So maybe even speaking to your bank about an overdraft. Now, an overdraft is a very, very common solution to cash flow issues. So you overall at the end of the year, you might certainly be profitable, but there are certain periods of time that you have cash flow issues. Now, that could be because of seasonality. It could be a number of reasons, but an overdraft is a fantastic and very easy solution for that. Now, the very final step and the most important step of all is to simply review your estimated cash flows against your actuals. So going back to that cash flow forecast that I had on the screen, let's say, you know, you've got to the end of July, you didn't, you've had estimated obviously your actual cash flows for that particular period, but it came through with a different result. You'll have to go back and have a look at what those differences were. Why did your estimated cash flow differ to your actual? Why didn't it meet your expectations? Was it lower sales than forecast, or was it higher expenses? You'll have to take action depending on what the reason is. So different actions for different situations, essentially. So if it was an expense related thing and there was a major expense that you didn't anticipate, then obviously, you know, that you'd have a reason behind that. If it was lower sales, have a look. Why was it lower sales? Was it our advertising? Was it, something else went wrong? Was it weather? What was it that actually impacted your sales? Because you might then need to relook at the next month's sales and the next. And if you're starting to see a decline or a trend there, then you'll have to take appropriate action. Now, remember that cash flow is all about the timing of the flow of cash. So when you're preparing that cash flow forecast, make sure you're as accurate as possible about that timing. Because then when you're comparing your actuals to what you estimated, it will all make sense. If you're not accurate and if you're not realistic in any of your estimations, then on this at this moment of comparison, it's all going to seem it's not going to be relative or relevant, and it's all going to sort of fall apart at that point. So be as realistic as possible. Now, in terms of cash flow mistakes, the biggest and most common mistakes that I see are, first of all, running a business from your bank balance. Sorry, clicked over there. Running a business from your bank balance, it doesn't account for any planned or unplanned expenses, or perhaps the season. My sound, I think there's something going on here. Sorry if my sound just cut out. I just got a strange message pop up that it did, so I'm hoping that it's working again now. So running a business from your bank balance, obviously it doesn't account for any planned or unplanned expenses, or perhaps even the seasonal nature of your business if you've got a high and low season. So some small business owners will get a bit excited when there's a bit of cash in the bank and sort of take it out. So absolutely don't do that. Another cash flow mistake is the improper management of taxes and government expenses. They're clear, they're known, plan for them. So whether that's GST, super, PAYG expenses, there's obviously penalties for late payments, and it's simple to account for those taxes. So do it in that cash flow forecast and in your planning stages. Spending too much money on sales is another killer when it comes to small businesses. You obviously need new customers, but at what cost? So make sure that you are actually tracking the acquisition cost of a customer, and then tracking the total revenue that each customer generates. Because it has to be higher than the acquisition cost. So if you're overspending on your marketing or your acquisition cost, it might lead to gaining a small value customer that has a limited return. So a lot of businesses have issues with that because they think that the more customers they have, the higher their profit will be. But like we were saying earlier, with regards to discounting, that comes into play there. So you have to know your customer value and how much the acquisition costs are, plus the cost of the sales, and then you know how much you can charge or how much you can potentially discount if you want to run promotions. Obviously, not forecasting is a big mistake, and obvious reasons that we've discussed today. So I hope that you've definitely got that one. Not collecting cash fast enough is a big mistake as well. If your customers are delaying payments, but your supplier terms are short, then you're the one that's in the middle getting caught out. Unpaid invoices are cash flow killers. And what's worse than late payments is invoices not being raised at all. Now, you'd be surprised at how many companies that, even I've personally dealt with, that forget to invoice you. And it could just be an invoice here and there. But that's big money for a small business, or potentially big money. I'm always honest. I'll let them know to invoice me, but I'm sure not everyone is. So consider that. Make sure that your processes and procedures are in place and strict enough so that everything is accounted for and everything is invoiced. Another cash flow mistake is holding your inventory for too long. It costs you a lot of money, and we've discussed that. So inventory represents cash. You don't want it just sitting there doing nothing for your business. The other thing that is a cash flow mistake is taking too much cash out. So if you have to take out money out of your business, don't do it sporadically. Make sure that you've planned for it on your cash flow forecast. You absolutely have every right to take money out of your business, particularly if you're working in your business and maybe not getting a wage. And you obviously have to be earning money for the work that you're putting in, but account for it and plan for it. Now, if you suffer from negative cash flow, you can absolutely recover from it. You have to first find out what caused the issue in the first place. Was it higher expenses, lower sales? Obviously, like we've said, go through each of those strategies, change your payment terms, reduce your operating costs, run promotions to get new sales, and then potentially even meet with a lender or an investor to see if there's some input you can have there. All right, so that wraps up the session on cash flow. I hope it makes sense to you. I really hope there's some things that you can take out of this to improve or at the very least better understand the cash flow position in your business at any given time. Now, I'm going to stay on now and answer any questions that you might have, but keep in mind, we've really just scratched the surface today. So if you want to know more or talk about any other aspect of your business, you can book a one-on-one appointment with me or any range of our advisors. We have more than 20 advisors that specialize in a range of different topics. This program, as I mentioned, it's a Commonwealth government initiative. So you are getting some extremely subsidized professional advice and guidance. So for $44, it's a 7-hour package, and that incorporates 3 one-on-one sessions with one of our specialist advisors, as well as a range of webinars and workshops like you've attended today. So like I said, I will stay on now and answer any questions. Just one last thing to keep in mind with regards to this Commonwealth government initiative, there is some eligibility requirements. So do you have an ABN that's registered in WA, Queensland or NT? Make sure that you're operating for profit. Again, you don't have to be profitable, but you can't be a not-for-profit, and you have to employ fewer than 20 full-time staff. So thanks again for joining me. I wish you the best of luck with your cash flow. Please shoot through any questions that you might have, and keep in mind you'll get a recording of today's webinar after the session as well. Have a great day.